Welcome back, ladies and gentlemen, to the Peak Trading Lab. And in today's video, I want to talk about the remaining entry patterns. And I began with entry pattern 1 in our last video. I apologize, I've been offline. I've been quite committed, but I'm back. So I want to resume so that you can be able to see the remaining entry patterns now. If you've not subscribed to the YouTube channel, consider subscribing. Hot content has been lined up your way. Now this is another entry pattern, the QM entry pattern, and I talked about the QM. I'm linking it with this video so that if you've never watched the video about the QM, you can be able to go through it. Now we have the high, we have the low, we have the high, we have the lower low. It looks like a head and shoulders pattern, but it is not the same because the head and shoulders pattern, the neckline is almost the same, but this one is a slanting one, So we have this type of formation. We always strive to enter based on this left shoulder. This for the sell setup, at least you'll be able to flip everything to get the buy setups. So whenever the market breaks this low or the short-term low, it signals potential reversal that sellers are becoming dominant. So the market, you wait for it to retest this particular shoulder. But I like it best if this shoulder has a nice supply level in line with it. So whenever you enter at this particular point, you stock the supply area because you always strive to enter in a supply area that is lined with this shoulder. That is the highly probable one. So your stop loss at least is placed above the supply area, or alternatively, this is depending on the risk parameters. So this one is the QM entry. Another entry is the breaker entry. And a breaker is the candle that initiated liquidity to be taken. The market was moving, then it retraced, then it took out this liquidity that is residing above this short-term high. So in this sense, it might sound like a bullish order block, but in it will be negated, it will be ignored, it will be violated. So whenever it is violated, it will become our bearish breaker because the institutions will be using this breaker now to push price further to the downside. So whenever you enter based on the break, at least it is the candle that initiated this liquidity to be taken out. The buy stops are activated. In real sense, in future they'll be at loss, and also the stop losses are hit. So what I like about this breaker block, number one, at least to validate it, I must see a clean liquidity or stop hunt. And this stop hunt should be the one that initiates the break of structure. Also, at least the break of structure should be realized. Then at least what I like to see, two things can happen here. Number one, a clean break, whereby the market leaves a huge imbalance in the marketplace. If it is left, this one also can be valid. Also, it can have an order block in line with it. So we look at the breaker block. It is the one that initiated this liquidity to be taken out. So it will be our bearish breaker when price has broken below it. So it will retrace to it, and the institutions will be using it at least to push price to the downside. Of course, if you want to get for the buy side of the curve, you just flip everything that I've talked about all together. Now, lastly, we have the mitigation entry, whereby initially the market created this high, traded lower, retraced, but this high never went above this high. So it's called a shift in market structure. So it gives us a failure swing. It gave us a failure swing. So whenever it gave us a failure swing, or almost the pattern looks more or less the same like the breaker, but the difference come in whereby the breaker liquidity is taken out, but in this one the mitigation block liquidity is not taken. We have a failure swing instead, the market giving us a shift in market structure, the SMS. So when it is violated, wait for the market to retest it, then take your sell entries from there. Of course, if you want to get the buy side of the curve, you're allowed to flip everything all together. Now, course, you can be able to see there was this liquidity that was taken out. There was this liquidity that was taken out. So this short-term low was taken out. When it was taken out, there is something that was responsible for the liquidity to be taken out. We have this block here. So we had a clean break. This one was now our breaker entry, whereby it initiated this liquidity residing below here to be taken out. Then the market violated it. The market retraced into this breaker block. This is where we take our entry from. So our entry is always based on the breaker block. If you get this type of scenario, stop loss placement is just slightly up below it for this context. So the market gave a nice run to the upside. So it was a breaker entry. Now there is this one also. The QM for buys. We have the low, high, lower low, higher high. The market tested into it. But I said, of course, you must see a demand or supply level depending on the context. So we had a nice demand here. This candle, whereby the market bought from that particular candle, this candle. So it is our demand level. So the stop loss placement will be based on that demand level below it, because actually the market was framing, but you can be able to see how the market respected it and it gave nice run to the upside. So that is the breaker entry. Let us look for the mitigation entry. And let me use the dollar index for that particular example, because I saw something on the dollar index interesting one. Now the dollar index, I want to draw attention to this, that I can save on time. So that I can save on time. The dollar index, if it is not here, we can, it is here. So we have this low, this lower low. The market went to the upside, then gave us a fail swing. It never went below this low. So it was a shift in market structure at this particular point. So we shift our focus to this one, to this block. It is our mitigation block. We can be able to see how price reacted into it before dropping. So basically our entries are always framed in what I talked about in the episode 1 and the patterns that I've talked about in this episode. So your supply and demand levels can be in the form of the order blocks, breaker blocks, the mitigation blocks, the value gap, the imbalances. So depending on the context, you try to frame and phrase these types of entry patterns. So go to the charts, try to backtest, and in the long run, you'll be able to see how they tend to happen in the marketplace. Until then, I'm wishing you good luck and good trading. Let us meet each other in the next video.